Thank you for joining me. I'm Gord Long. A reminder before we begin, do not trade from any of these slides. They are commentary for educational and discussion purposes only. Always consult a professional advisor before making any investment decisions. In this year's third Under the Lens video, I'd like to conclude with our final video in this three-part series. In this session, we want to focus on the tradable outlook and investment conclusions based on the thinking in part 1 and 2. I covered a number of important parts of this discussion in my recent video with Charles U. Smith. If you haven't viewed this 53-minute video with 37 supporting slides, I highly encourage you, as I'm not going to duplicate those messages here. The timing of that video has allowed me the opportunity to cover additional materials, which I originally thought I wouldn't have time for. We are presently in the midst of an inflationary boom, with that evidence showing in the form of rising interest rates and inflation break-evens. The initial stages of inflation are normally good for stocks as prices rise on the belief in money losing its value and will only make stocks worth more in nominal terms and even in real terms for those who get in early. It is our belief that by Q3 of this year, that sugar high will have run its course and equity markets will be in decline. By Q4 and into 2022, the disinflationary bust will be giving way to the initial stages of our previously outlined deflationary tsunami. Inflation in financial assets will by then be giving way to a reverse wealth effect. Incomes and disposable income in our 70% consumption economy to global supply chain bankruptcies, downsizing, cost controls, accelerating use of ubiquitous robotics, and falling U.S. purchasing power as the U.S. dollar weakens. A falling U.S. dollar will place rising pressures on the price of foreign goods and real U.S. disposable incomes. As I pointed out in prior videos, we will continue to have both rising inflation and deflation, but the focus will shift to deflation since it will be the one being increasingly most evidently felt. I spelled all this out in the deflationary tsunami video, including a discussion regarding these particular set of correlations we should expect during this period of evolution. What I need to stress here is that the coming deflationary period and hyperinflation event will occur over the current unfolding decade of the 20s. It is going to be a protracted period. This is not something you trade, but rather something you begin to frame an investment thesis around. However, there will be plenty of trading opportunities because the volatility levels will be high. The markets have more to go. Retracements and consolidations are only getting bigger. Bear market counter rallies are notoriously violent. Fiscal policies of MMT and expected government bailouts, guarantees, and market manipulation can be fully expected. And even when the market has run its course, as shown here by the red parabolic trend, tops are a process and then will take, at that point, some time to put in. In the very near term, as shown here by a daily chart, we believe we are putting in a near-term market top, whether an anticipated head and shoulders formation pattern as labeled here, or an M-top, which also is showing itself as a possibility. We see the markets correcting and consolidating into Q3 of this year. Our views on the 10-year U.S. Treasury note indicate we have further to go with bond yields, which is going to impact equity markets as we move towards the 1.75 to 1.85% range. This is likely to temporarily lower yields in a flight to safety, as shown by the red wave D, before heading higher and likely triggering yield curve control at a level somewhere over 2% to 2.25%. The long-term U.S. 30-year Treasury bond will maintain its well-managed trend channel, with upper levels likely being in the 2.66 to 3% range before rolling over. What is important to note that though the U.S. dollar can be expected to rise in the short term with a flight to safety shift, it will then begin a approximately 12 to 15% decline, as labeled here on the DXY, in a black C wave of an ending ABC correction. At the red B, we then expect the dollar to rise strongly towards the green 2 shown at the top right. The converging dotted trend line suggests this to be sometime near the U.S. midterm elections. As bad as things might appear in the U.S. at that point in time, labeled as B, The problems will be even worse in the EU, Japan, and the emerging markets. We've always believed and stated that the US dollar will be the last to fall as the era of fiat currencies ends and are replaced with the inevitably required policies of sound money. As you can see at the bottom, we believe this will occur out into 2026, 2027, as our parabolic equity chart earlier also suggested. The coming tsunami shown here is not the deflationary tsunami of our video, but rather a larger global one of a hyperinflationary bust of the global fiat currency system due to unsound money. We see the short term in 2021 progressing through the stages as represented here as cascading dominoes. High and rising chronic unemployment as COVID appears in the rearview mirror, an onslaught of corporate and small business bankruptcies, falling consumption as real disposable incomes shrink, falling real estate values in both commercial and residential housing. The Zoom economy has restructured corporate attitudes about office usage and the opportunities for major cost reductions going forward. A reverse wealth effect as leverage is reduced from the equity markets and stock prices fall in the intermediate term. We will experience a credit crisis from excess leverage, insufficient real collateral, and short-term funding restrictions the Fed just simply can't fix. We need to remember the bailouts and stimulus programs started in 2008 when the Federal Reserve intervened with the insolvency of Bear Stearns. They simply haven't stopped since. To date, the Federal Reserve and the government have pumped more than $36 trillion into the economy. You can rightly conclude there must be a limit to what the Federal Reserve can do with more money creation and regulatory gimmicks. However, don't ever underestimate the way politicians and unelected bureaucrats now operate versus only a single short generation ago. As this chart illustrates, in the 1930s, the economy went south and the markets went with it. Today, the economy can be expected to go south, but the financial markets will never be allowed to follow. Never. The powers to be will make contingent liability guarantees or even nationalization to any degree is required. Governments have become the dominant controllers of more and more economies through exponential debt creation and massive transfer payments. We have allowed this to occur by the willing and unwitting surrender of our personal securities in the form of economic, financial, physical, and health security. As a result, suppression has become the norm, as we pointed out in this year's thesis paper, Social Suppression. This is in addition to the ever-expanding macroprudential policies of financial repression, which we have also detailed in previous thesis papers. All this is leading to this period we mentioned previously. The question is only about what this will mean to a country's fiat currencies relative to others in the Bernanke's enrich thy neighbor coordination doctrine, as we follow this well-established roadmap towards a forced and inevitable return to sound money. Never forget that real wealth is created by growing it, mining it, or building it. You can't print it, at least not for very long. As the games are played to keep the growing disconnect and divergence between financial markets and the economy maintained, real assets, in the form of hard and soft commodities, will inevitably be sought after to maintain wealth. Presently, those historical types of assets are dramatically undervalued, but that is changing as we have witnessed a strong resurgence in all commodities recently, and we can expect that to continue to play out throughout this decade in a volatile fashion. We have concluded we are at the end of the debt supercycle and the beginning of the commodity supercycle. We outlined this last year in the video entitled, Is 2021 the Year of Hard Assets?, as well as other UnderTheLens and long wave videos. So far, we have been proven right. We've also outlined years ago, we expected the 20s to be about commodity-backed money and what we referred to as the indirect exchange. Those writings and videos can be found in our archives. There is a strong possibility that what we are likely to witness going forward is that the Fed lets the long end of the curve rise. Let a crisis be a forcing function, using an effective taper or expected taper tantrum to make this happen and control rates. A crisis event will negatively impact an over-leveraged equity market. A flight to safety will drive yields down and prices up. Increased bond prices and lower yield will assist short-term funding. Initially, this will take the dollar higher through August. As the economy focuses begins the shift from inflation to deflation, the Fed will be at the point of launching yield curve control. We don't have a real inflation scare. We actually have a rate scare. We don't yet have secular inflation. A deflationary tsunami is ahead, as evident from the inverted 5-year, 10-year yield curve, a global imbalance of economics producing less than they consume. Yield curve control will be implemented as rates rise once again. This will take the U.S. lower, thereby assisting the Fed with low rates. The Fed will sacrifice the U.S. dollar to be able to stabilize lending and government debt requirements. Stagflation, similar to the 70s, is ahead. This time we have too much debt to pull off a Volcker-type approach to halt inflation. Money printing won't work because of MCM velocity, which will continue to fall. Hyperinflation will be the outcome, which will be halted by a new Bretton Woods. This new Bretton Woods will be held in Beijing versus New Hampshire. The problem is a global imbalance of economies, as I said, producing less than they consume. As smooth as the roadmap might appear, it will be anything but. Shocks can be expected. Be prepared and hedged at all times. That means starting now. Given that crises frequently occur when rates rise sharply, we should contemplate how high rates can rise before the next crisis. Notice as time goes on, it takes less and less of a rate increase to generate a problem. The reason is the growth of debt outpaces the ability to pay for it. As this chart shows, the current 1-year change in the proxy interest expense is up 3.5% from a year ago. The last two significant crises in 2000 and 2008, along with a few minor ones, all happened when the proxy rose between 3 and 4%. If 10-year U.S. Treasury yields increase to 2%, currently at approximately 1.6 to 1.7% by May, the proxy will increase to 5.25%, well above 4%. That popped the dot-com bubble and the housing bubbles. The Fed's problem is that while they may not be hiking rates, the bond market is doing it for them. Given the Fed's actions are what causes rates to rise by shifting risk preferences, the result will be a deflationary crash requiring more interventions and lower rates. As I always remind you in these videos, remember politicians and central banks will print the money to solve any and all problems, until such time as no one will actually take the money or it has no value. That day is still in the future, so take advantage of the opportunities as they currently exist. Investing is always easier when you know with relative certainty how the powers to be will react. Your chances of success go up dramatically. The powers to be are now effectively trapped by policies of fiat currencies, unsound money, political polarization, and global policy paralysis. I'd like to take a moment as a reminder. Do not trade from any of these slides. They are for educational and discussion purposes only. As negative as these comments often are, there has seldom been a better time for investing. However, it requires careful analysis and not following what has traditionally been the true and tried approaches. Do your reading and make sure you have a knowledgeable and well-informed financial advisor. So until we talk again, may 2021 turn out to be an outstanding investment year for you and your family. And I sincerely thank you for listening.